What if the global financial system is no longer driven by choice, policy, or ideology, but by arithmetic that has already removed every viable alternative? What if rising debt, falling productivity per dollar, and accelerating technology have quietly pushed policymakers into a position where money printing is no longer a tool, but the only remaining escape hatch? And what if artificial intelligence, rather than solving these problems, is actually exposing the fragility of a system that cannot survive falling prices, rising efficiency, or widespread unemployment? In a recent podcast conversation, James Lavish argues that we are approaching a moment where markets are forced to confront this reality head-on. He explains why interest rates cannot stay high, why liquidity must return, and why both gold and Bitcoin are reacting to the same underlying pressure, even if they move at different times. If he is right, then volatility, political tension, and monetary expansion are not temporary distortions, but the logical consequences of a system that has already run out of degrees of freedom. Hello everyone, and welcome back to another podcast summary video. In this episode, we break down James Lavish's recent appearance on the What Bitcoin Did podcast, a wide-ranging macro conversation that runs for just over an hour and begins with a deceptively simple question. What happens when debt grows faster than the economy that is supposed to support it? What follows is not a discussion about short-term market moves or price predictions, but a structural examination of why policymakers, central banks, and investors are increasingly boxed in by forces they no longer control. James connects sovereign debt, interest rates, artificial intelligence, political incentives, and global liquidity into a single framework that explains why monetary expansion is becoming unavoidable, regardless of who is in charge. We've distilled the most important ideas from the conversation into a clear, structured breakdown so you can understand the argument without needing to listen to the full episode. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps support the channel and keeps this content coming. Now, let's walk through James Lavish's argument from first principles and why it leads to conclusions most people are still resisting. The conversation begins with a stark reality that most people either ignore or don't fully grasp. Sovereign debt has reached a scale that renders traditional economic tools almost meaningless. James lays it out clearly. Today, the United States carries more than $34 trillion in federal debt, while continuing to run annual deficits in the range of $1.50 to $2 trillion, even in periods that are considered economically stable. These are not extraordinary conditions. This is simply the baseline. The implications of that number are staggering when you realize that interest payments alone are approaching $1 trillion per year, a figure that rivals the federal budget for defense or social programs. At this scale, interest rates stop being neutral levers of policy and instead become a source of instability. Even modest increases in rates threaten to crowd out government spending, destabilize bond markets, and push the broader financial system closer to the edge. James frames the situation as a closed set of options, none of them particularly pleasant. Governments could try austerity, slashing spending across the board, but history shows that this is politically impossible at scale. They could default or restructure, which would destroy confidence in the system and create far-reaching ripple effects across global finance. They could try to grow out of the problem, but once debt surpasses certain thresholds relative to GDP, the math simply doesn't work. The final path, and the one history repeatedly demonstrates, is debt monetization, using the currency itself to absorb the excess. James emphasizes that this is not about morality or greed or bad leadership. It is arithmetic. Once debt reaches a critical point, outcomes are no longer optional, and the system essentially forces itself into the path of least resistance. And the tension in this story is palpable. If the math is unavoidable, what comes next is almost certain, and few are ready to face it. From there, the conversation moves into why the system can no longer restrain itself. James explains that as debt grows, the tolerance for economic contraction disappears almost entirely. Even minor slowdowns risk cascading defaults, unemployment, and political instability. This is why the repeated headlines about interest rate cuts and liquidity injections should not be misinterpreted as generosity or incompetence. They are not choices made for comfort. They are structural imperatives designed to prevent collapse. The markets may argue over timing or intensity, but the trajectory is already set. Rates must fall. Balance sheets must expand. Liquidity must flow. Because if it doesn't, the consequences are immediate and severe. James makes it clear that this reality has nothing to do with promoting Bitcoin or any ideological agenda. It is simply the way debt-based systems behave when leverage reaches saturation. Once that threshold is crossed, inflation becomes not just likely, but necessary. Printing money is no longer a policy option. It is the only escape hatch left to keep the entire structure from toppling. And the suspense here is intentional. The system is walking a tightrope where every step is dictated by arithmetic, not choice, and the slightest miscalculation could ripple through markets, institutions, and governments in ways that feel almost unstoppable. The discussion then pivots to artificial intelligence, which James identifies as both a blessing and a destabilizer. AI dramatically increases productivity by reducing the cost of labor, both physical and cognitive. What previously required entire teams can now be accomplished by a single individual equipped with the right tools. In a normal system, this would be revolutionary. Prices would fall, real wages would rise, and society as a whole would experience abundance. But in a debt-driven system, falling prices are dangerous. Deflation increases the real value of debt, exposing vulnerabilities across governments, corporations, and financial institutions. The very progress that should empower people instead forces policymakers to expand monetary supply even further, neutralizing the benefits of innovation. AI, rather than being a liberating force, paradoxically becomes a mechanism that intensifies dependence on monetary intervention. The tension here is dramatic. Technological progress, which should feel empowering, is actually forcing the system to work harder just to maintain stability. Productivity no longer translates to freedom. It becomes a liability. James then moves to the social and political consequences of AI-driven productivity. As automation spreads, it is entirely possible for economic output to rise while employment falls. The economy grows, goods and services increase, but fewer people are needed to produce them. This breaks one of the foundational assumptions of modern governance, that growth creates jobs. Without this link, governments face an impossible dilemma. They cannot tolerate mass unemployment, yet the system they manage inherently reduces the need for human labor. This tension is where discussions around universal basic income emerge, not as a philosophical ideal, but as a politically unavoidable response to structural realities. James is candid about the challenges. Any transition from a labor-based economy to a post-labor one is likely to be messy, inflationary, and socially disruptive. There is no smooth path here. The system is evolving faster than existing structures can accommodate, and the political, social, and monetary consequences will be unavoidable. The suspense builds naturally. The economy is efficient, but the society built to manage it may not survive the transition without conflict and instability. As the conversation shifts to central bank leadership and market reactions, James uncovers a subtle but critical truth. Markets rarely believe the public narrative. Recently, speculation about changes at the Federal Reserve sent gold and silver prices tumbling while Treasury yields swung violently. On the surface, this looks like a dramatic market response. But the reality, James points out, lies deeper. Fed funds futures barely moved, with the implied terminal rate lingering around 3.1%, signaling that investors do not believe any Fed chair can meaningfully alter the system's trajectory. Rhetoric may change. Speeches may shock or surprise. Headlines may scream hawkish or dovish. Yet the underlying constraints remain the same. Debt saturation demands lower rates and renewed liquidity. The market understands this quietly, even when public discourse lags far behind, creating a tension that is invisible to casual observers but impossible to ignore for anyone paying attention. James then delves into the nuanced performance of gold, silver, and Bitcoin, revealing patterns that challenge conventional assumptions. Central banks have been accumulating roughly 1,000 tons of gold annually, nearly double the historical average, reflecting declining trust in treasuries and the dollar system. Gold and silver rallied for 18 months, only to pull back sharply, a move James interprets not as failure, but as an inevitable market reset after an overextended climb. When volatility subsides, he notes, capital often rotates into other assets, seeking yield or safety. Bitcoin, in contrast, has lagged behind in this rotation. This is not a failure of its thesis, but a reflection of liquidity dynamics. In risk-off events, investors sell what they can, not what they want. Bitcoin's liquidity makes it an easy source of cash, particularly during drawdowns. James cautions that in a broad liquidation scenario, Bitcoin could dip into the $50,000 to $55,000 range, and even touch the high $40,000s. But he frames this as a short-term risk, not a long-term invalidation, reinforcing the lesson that liquidity dynamics often dominate fundamentals in the near term. James emphasizes a point that most mainstream commentary misses. Liquidity is far more than just rate cuts or quantitative easing. It is a complex ecosystem encompassing treasury issuance, repo markets, collateral availability, and volatility in government bonds. All these components determine how much risk institutions can actually take. If multiple elements tighten simultaneously, markets can experience stress even when the Fed appears neutral or accommodative. Quoting Michael Howell, James explains that global liquidity can expand or contract independently of central bank actions. Large bond issuance, rising volatility, and collateral demands quietly absorb capital, creating systemic pressure that eventually erupts in falling asset prices or sudden instability. The takeaway is profound. The public often misreads headlines as policy-driven chaos, when in reality, liquidity flows and shortages move in patterns that are largely invisible until the consequences manifest, often violently. It's a hidden engine controlling much of the financial world, and understanding it is key to navigating the system. The conversation then shifts from theory to practice, as James explains how professional investors adapt to these structural realities. His fund operates on a Bitcoin standard, maintaining significant long-term exposure while using options and hedges to manage downside risk. The goal is not to predict the market, but to survive, remain flexible, and exploit volatility. When markets decline, these hedges create capital that can be redeployed into Bitcoin and related assets at lower prices, generating convex upside over time. This approach emphasizes discipline over speculation. It's about avoiding forced sales during stress, staying solvent, and positioning for opportunity without succumbing to panic. James' insights illustrate a critical lesson. Professional success in such a system is rarely about intelligence or foresight. It is about structure, preparation, and understanding how leverage and liquidity shape outcomes. Finally, James addresses the question on everyone's mind. What does all this mean for Bitcoin? Despite near-term volatility, liquidity risks, and market fluctuations, he remains confident in Bitcoin's trajectory. He views price weakness not as a broken thesis, but as a temporary disconnect between liquidity cycles and structural fundamentals. As adoption spreads across pensions, endowments, and sovereign entities, volatility is likely to decline and price discovery will become more structural rather than speculative. James projects that Bitcoin could reach $1 million per coin by the early 2030s, driven by ongoing currency debasement, institutional adoption, and the closing knowledge gap among the public. His core argument is deceptively simple: buy Bitcoin while it is still misunderstood, and sell it when it becomes obvious. But beneath this simplicity lies a layered and nuanced understanding of debt, monetary policy, liquidity, and human behavior that most investors have yet to internalize. In essence, Bitcoin is not just an asset. It is a lens through which the modern financial system, with all its paradoxes and hidden pressures, can be understood.